Hello, everyone. Thank you for joining us today. We're going to get started in just a moment. We're just giving folks a second to get logged in and get settled here. If you have any questions for Matt Anderson during the presentation, you may enter them into the chat or the Q&A panels, and we'll read those out for you. I'll also be putting Matt's contact information in the chat box in case you'd like to follow up with him later. Again, thanks for joining us. We will get started in just a moment. All right, Matt, we can probably get started. Looks like we have everyone on time today.
Perfect. Thank you, Lisa. Again, my name is Matt Anderson. I'm the LTC Sales and Marketing Manager here at CPS. I'm excited about our conversation today, Mastering the LTC Conversation. Really just a step-by-step guide for advisors to follow to have a conversation about long-term care. What I find in general is that a lot of the advisors I work with know the basics of LTC, but they're lacking a step-by-step process to make sure that they're doing the same thing over and over again with clients, bringing it up proactively to have those right conversations. And this whole presentation is designed around giving you that process so that you know exactly how to have that conversation with your clients. So today we're going to talk about really three things. What does the sales process look like for long-term care? It's a little bit different than some other lines of business. How to have a conversation around long-term care need without driving clients away, but pulling them in closer, getting them interested. And then maybe give you an example of some designs that are working currently and how I would present those designs if I was talking to a consumer. So the three-step LTC sales process. I'm a big believer in scheduling time to do these things. So step number one is really schedule a time to talk LTC 101 with the client. And that's where you're going to present first the basics of LTC. I've got a presentation for you that I use. I'm going to give everyone on the call today that same presentation. You could feel free to use it, revise it, make it yours. It doesn't matter to me, but it's a great start to finish how to have that LTC 101 conversation. In that first meeting, I also like to gather some facts. So after I make that presentation, I like to get a little bit of the basics, right? Do they have any experience with a friend or family member needing care? What does their family history look like? If they had a choice, where would they like to receive care? They want to be at home. That's an important question. Most people with a plan have a strong preference to receive care at home. One of the big pieces that I think is extremely important to know is what does their financial picture look like? As a financial advisor, that's something that you may already have. If you have that, it's a huge advantage. It really helps designing something that's meaningful for that particular client. But if you don't know their financial picture, ask the questions, right? You know, are they still working? What's their asset situation look like? What kinds of vehicles do they have their investments in? Are they using annuities? Is it cash? Investments, non-qualified, qualified? All of that can help us design the best plan for their particular situation. And then kind of at the end of that first meeting, I'll also talk about, you know, are there any health concerns or what's their current health look like to make sure that I've got a good handle on that. The second step of the process is scheduling a second call where you're actually going to be presenting the numbers. So it's a little bit different. I'm a big believer in keeping these two things completely separate. If someone's not very familiar with long-term care, right? So meeting number one, cover the LTC basics, get some fact gathering stuff. Meeting number two, that's where you're going to then present the numbers that you have put together and the different plan options that you would recommend based on their particular situation. And then the third step is either close it at that second meeting, or if you need to schedule another call to first make some revisions and then close and complete the app, would be step number three. So let's dive a little bit further into kind of what step one looks like, which is that LTC 101 chat. This is the presentation that I use with all of the consumers that I'm talking directly with. CPS does offer point of sale. So if you need someone to talk with your client, make the presentation for you, make recommendations, take the app, we can do that with you if you'd like. but this is the presentation that I would be using for that meeting. I always want to get on the same page with the client to make sure that we're speaking the same language. So I let them know, we're going to talk about what specifically is long-term care. What are the costs of care today, and what do we expect the cost of that care to be in the future? And then what are the different ways that we could put a plan in place? Because that's really what it's all about. So first, what is long-term care? I'm going to go through this a little bit quicker than I regularly would because most of the people on the call are advisors and they are loosely familiar with it, but you could slow it down with the client. So long-term care really is just the care that you need when you can no longer care for yourself independently. There's two different ways that you can turn these plan benefits on. The first would be if you need assistance with your activities of daily living, 2 of the 6, that would qualify you for benefits. So that would be bathing, dressing, transferring, eating, toileting, or continence. If you need help with 2 of the 6, that automatically switches the benefits on. Completely separately, if you have any type of cognitive issue, that would also turn the benefits on. Cognitive issue that requires supervision. So I typically like to give people an example. I find arthritis is a great example because people can imagine that as you age, could you imagine yourself getting arthritis? You lose the dexterity in your fingers, and now it's a little bit difficult for you to bathe in the shower. You can't get your arms above your head to wash your hair. Can't move around too well. You don't have the dexterity to put your shoes on or do the buttons on your shirt or your pants. That could be an issue with getting dressed. So something simple like arthritis as it progresses could be a triggering event for long-term care. I think it's super important to then transition into what is the cost of care today, right? And these care costs are really going to range depending on where you are in the country and what environment you're talking about. These are just some typical averages, right? So home care on average, about $7,000 a month for home care. Assisted living, $7,000 to $8,000 a month, and then facility care, $10,000 to $14,000 a month for a facility care environment. I think this is probably the first point that I see people get off track. So one of the most common requests I receive from advisors is, Matt, show me a $10,000 monthly benefit with a 5% compound inflation growth. And then they look at the premium cost and they're like, well, we can't afford this. This is way too expensive. I'm a big believer when it comes to long-term care of not over-insuring. And what I mean by that is home care, it really does range, right? 7,000 maybe on average, but maybe initially you just need a little bit of help with kind of your activities of daily living. Maybe you need someone over there for a couple of hours, and not until it progresses further along the way would the cost start to pick up. But if you don't have a plan and now need to come up with $7,000 a month in extra income, that can be difficult. If you have a plan that maybe covers half of it, or if you have a plan that covers $4,000 a month, that is absolutely going to be meaningful in providing a benefit. And now the rest of the portfolio only needs to generate maybe $3,000 extra as opposed to that full $7,000. One of the most, I think, impactful things on my career was listening into claim calls with Genworth. So they put me on the phone and I could listen into some of those claim calls. People would call in and they'd have access to $2,000 or $3,000 a month in benefit and would be in absolute tears that they've got that extra additional monthly benefit that they can use to pay for the cost of care. Because while on claim, those are some of the most expensive months that you go through, right? And so that extra $2,000, $3,000, $4,000, whatever it may be, absolutely is going to make a meaningful difference. So when we're designing these plans, we want to make sure that we're sticking within their budget, but also giving them some type of relief for a portion of the cost of that care. Some general statistics. Oh, the last thing I'd say is I generally try to concentrate on the cost of care for home and assisted living, not necessarily facility care. And my thought process there is, the average length of stay in a full-time facility care environment is about 9 months. So if you're paying $10,000 a month for 9 months, that is expensive, but it's over relatively quick. The length of care that is needed in the home environment and assisted living environment is significantly longer. And I'm worried financially about those claims that are lasting significantly longer. So a couple of statistics that you see often is about a 70% chance of someone over the age of 65 needing care. Average care, average length of claim is around 3.4 years. It's probably a little high for men, but 3.4 years maybe for females. Men, it's a little bit less. And then something like Alzheimer's or dementia, those cognitive claims can certainly be 8 to 10 years in length. I think one of the things I like to point out is that the average length of claim is probably the single most misleading statistic out there. And the reason for that is if you really look at the average length of claim, it's a bunch of claims that are lasting 6 months to 9 months, and then they're over. And then it's a bunch of claims that are lasting longer than 3 years. So the most commonly purchased LTC plan is a 3-year plan, but no one's really having a 3-year claim, right? It's either less than a year or usually a lot longer than 3 years. So we want to make sure we're designing a plan that's going to be able to cover some of those longer claims because those are the financially meaningful claims that we want to protect against. If you have a 6-month claim or a 9-month claim, you're going to be fine without an LTC plan. I'm not financially worried about those claims. I'm worried about the claims that are not over within that first year. Then I generally like to talk about what's the cost of care tomorrow, right? So today we saw what it was. This is just projected out in 20 years. What do we expect, home care to cost, assisted living to cost, and facility care to cost? We have no idea what those numbers are going to be. If you look at the cost of care survey that Genworth CareScout puts out, those inflation numbers really picked up this year. I think some of them were 7, 8, 9% year over year growth. So historically, it's been less than that, but we don't know how that's going to change down the road. But the idea is you're healthy today. This is going to be a big expense down the road. And how are we going to pay for it, right? And when it comes to how you're going to pay for it, there's really 4 viable options to pay for care. Some I prefer over others, but it is what it is, right? So the first option, which is what they are currently doing, is self-funded, right? So if you should need care today, where are you going to get the money to pay for that care? Maybe coming out of a qualified account, maybe coming out of savings, doesn't matter, but you're going to be paying dollar for dollar for the cost of care. And maybe you could argue even more than $1 for the cost of care, because if it's in a qualified account, you've got to take that withdrawal, pay your taxes, and then you're going to pay for the care beyond that. So self-funding is certainly a viable option, but it is the most expensive way to go. Second option is traditional long-term care. That's certainly been around the longest. It's generally laser focused on long-term care only. It is a pay your monthly annual premiums, get a big pool of money for long-term care. Some of the complaints about that type of plan is that if you never need it, you've wasted your premiums, or sometimes the premiums can increase because the premiums are not guaranteed over the life of the policy. Then we've got hybrid LTC, which is my personal favorite way to address long-term care, which is heavily focused on long-term care. That's what it's primarily doing, but it's got some backup benefits in addition to the long-term care. So it allows us to do a couple of things that are unique that the traditional plan can't do. We can pay it up quicker. We can have guaranteed premiums. We can have some return of premium options so that if they never have an LTC event, they get their money back. Just gives you a little bit more flexibility, but still primarily focused on solving for that long-term care need. And then the final 4th option is life with an LTC rider. That tends to be my favorite option if someone has a primary need of life insurance. So if they need life insurance, first and foremost, that's what we're talking about, and they want some flexibility for long-term care, we can purchase a death benefit that can also be used for long-term care. So I walk them through those options. Then I sit back and listen to what is their experience with LTC, do they have any family members, ask those profiling questions so that I can kind of get some insight into their particular situation. After that, I'll schedule that follow-up call where I'm going to be presenting some numbers. Presenting options. This is A lot of times I have advisors come to me and say, Matt, I need some LTC illustrations. Can you run some numbers? I'll run the numbers, send it to them, and then I'll see that they just forwarded my email over to the client and said, here are some LTC numbers. LTC doesn't work like that. That will never result in an LTC sale. Um, it's a conversation that has to be had around the numbers. One, because most of the illustrations are confusing, right? I have advisors that misread the numbers all the time. It's not necessarily intuitive how it works, and you want to make sure you're walking a client through the numbers one-on-one so that they understand what they're looking at and understand the need. You also want to hear how they're reacting to the premiums that you're showing. So when you schedule this second meeting to present the numbers, I strongly recommend not sending the client the numbers beforehand. You want to, for the first time, share your screen and show them what the numbers are. And after you have, you can then follow up and send them the illustrations if you'd like. But I don't like to send the numbers before I've been able to walk the client through. I think that is extremely important in determining whether or not it's going to be successful. So here's an example of a client that I was actually just working on last week. It's a husband and wife. Husband is 61, wife is 62. They are in California, and they're actually business owners. So this is kind of what I would put together to present some numbers for the client after that first meeting that I've gone through my LTC presentation, LTC 101 presentation. So I'm also a believer of showing a couple of different options. So here I've got a traditional plan, and I'm going to be showing them some alternative hybrid plans as well. I don't want them to see too much information, so I start with the traditional. And here, happens to be with Mutual of Omaha, but I've got a monthly benefit starting at $4,000 a month, and it's going to be growing every year that they've owned the policy. I give them some landing ages so that they can see what the benefits grow to. It grows every year, but I've got current year, and then when they're age 85 and 86, the monthly benefit will have grown to $8,000, a little over $8,000 per month per spouse. And then I'll give them the total benefit as well. It starts at about $400,000 shared between the two of them. And by the time they're 85 and 86, they'll have close to $800,000 that they can access 100% tax-free to pay for the cost of care. This is a shared plan, so it's 8 years. Benefit duration is 8 years shared, so maybe that's 4 years each, or maybe it's one passes away without having a need and the other has an 8-year claim. Who knows? But it's 8 years any way you want to divide it that they can use to pay for the cost of care. Again, the inflation growth is a 3% compound. Elimination period, they go and claim at home, 0 days. If they go and claim at a facility, there would be a 90-day elimination there. This is where the plans start to get a little bit different. So in this case, there is no death benefit. This is a reimbursement plan, which I think is a really important part, which we'll come back to. Again, the premiums are not guaranteed. They could always be changed or altered. Because they're business owners, though, that they can take that business owner deduction. So they've got about close to $8,000 that they can deduct because they're business owners. And the premium for a plan like that is $9,000 a year, paid annually for the rest of their lives until they go on claim. So I start with that as a traditional plan, and then I show a hybrid plan that's a similar design to that. This happens to be Nationwide's hybrid joint plan, Care Matters Together. Same monthly benefits as the traditional. It's about the same total benefit as the traditional. It is 8 years shared between the two of them. Same 3% compound. But now is where the plans start to deviate and start to get a little different. So Nationwide uses a true 0-day elimination for home care and facility care, unlike the traditional plan. It also has a backup death benefit of $144,000 second to die, right? So say the husband passed away in 20 years, nothing happens. But when the wife passes away, it would always pay out at least $144,000 if it hasn't already paid out something for long-term care purposes. A real big difference is that this is a true cash indemnity plan. That's important for a couple of different reasons. So when you have a reimbursement plan, you need care at home, we often see a delay in the claims being processed because Sometimes it's awkward to bring someone into the home and provide that care. And maybe the wife is going to start providing care for the husband, at least initially, until things get bad. So with the reimbursement plan, you see a delay. Even though they may be eligible for benefits, they're just kind of dealing with it within the family. With a cash indemnity plan, the wife can start collecting the money, right? There's no reason to delay that claim, and they can start collecting the money. And if they don't need it, they can just put it into the bank, which is a real significant difference. The other difference is that with cash indemnity, you can hire your unemployed uncle, you can hire anybody that you want and kind of pay them cash. You're just going to receive that monthly benefit, and you can do whatever you want with it as long as you're eligible for your benefits. The next big difference between these two plans is that the hybrid plan, it's guaranteed. The premiums cannot be changed, cannot be altered. They're locked in for the life of the policy, and you've got some reassurance there. The tax deduction, for a couple of different reasons that I won't get into, is a little bit less on this annual hybrid plan, but you'll note that the premium between the hybrid plan and the traditional is almost identical, right? And for me, this would be a no-brainer situation, right? Definitely go with the hybrid plan because it's cash, it's got guaranteed premiums, it's going to have a death benefit, it's going to have zero-day elimination. There's so many different, in every way, I think it's actually the better plan compared to the traditional, and it's about the same cost. The next thing I would show is the exact same hybrid plan, except now we're just setting it up to be paid over 20 years as opposed to be paid annually. And so for a 61 and 62-year-old client, it's an extra $1,000 a year. And now this thing will be fully paid up once they reach 81 and 82. I think that's an attractive proposition that they should potentially consider that 20 pay, because then they don't have to pay the premiums after that point in time. And then the final thing, show them a 10 pay, right? And that's actually my favorite design with this joint Care Matters plan, because you know exactly how much you're going to pay. You save some significant premium. You pay $15,000 a year for 10 years, at which point it's fully paid up. No additional premiums would be due. And you see that you still have that tax deduction. It's a little bit higher on the 10 pay design. Hopefully that makes sense. I don't want to overwhelm you, but that would be my process from start to finish. After you present this with the clients, you get their feedback. It goes to the, really the third and final step, which is you're either able to close and take the application at that point, or they want to see some revisions, and you can prepare those revisions and then complete the application at that next time. So step 1, 2, and 3, very straightforward, very simple, gives you a pattern to follow. I think one of the key pieces is that LTC 101 presentation in the middle that you can show the importance of having a plan in place. And then, of course, not giving them the quote numbers before you have that conversation with them. With that brings us to an end. Lisa, are there any questions in the chat?
Yes, we do have a few questions. The first one is asking about the assisted daily living, the ADLs. Could you cover those again? Were there 5 or 6?
Yeah, so this is I blame this on marketing. If you look at the slide, it does look like there's 5, but we've cheated and put 2 of the ADLs on the last one. So toileting is separate than continence. So if you count those as separate bubbles as they are, then if you need help with 2 of the 6 of those, then that would turn the benefits on. Good question.
Gotcha. Perfect. Thank you. And the other question is, we had a few people ask if a copy of the recording will be available. Yes, once we wrap and the recording is ready, I can send you a copy of the recording. Anyone that has asked, I've noted your name and email, and I'll send that to you right away.
And we'll also make sure that we send out the LTC 101 presentation. And again, feel free to use that as you choose, revise it, use it as is, change it up, steal from it. Everything's okay with that.
Great. And looks like that's it. Oh, wait, we have another one just come in. Can you speak to the tax deductibility for a minute?
Sure. So an easy way to kind of cheat is most W-2 employees, it's very difficult for them to deduct any LTC premium. But if you are tied to a business, right? So I'd say 60% of my business in California, for example, it's actually with business owners because there is that deduction. So if you're connected to a business somehow, you're able to move directly to a portion of the premiums are deductible for LTC. There's two different categories that are important to know. C Corps, which you very rarely run into. There's no cap on how much you can deduct for C Corps. So if you're the owner of a C Corp, your deduction's unlimited. If you are, most likely you'll be working with sole proprietors, S Corps, partnerships, LLCs or LLPs. Those are all pass-through entities, and you're able to deduct a portion of the premium based on age. And so for 2025, those age limits are right around $9,000, a little over $9,000 if you are 61 to 70. And you can look up what the max deduction is based on age band.
Perfect. I think that covers it.
Perfect. Thank you everyone for joining us. Appreciate it. And we will follow up with the email. Feel free to give us a call if you have any questions. Thank you all.